Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news that moves the markets. And this particular week, Tori gone for a couple weeks. So what do I do when Tori leaves? I go find better Tori in the name of Rob. Rob, thanks for coming and joining me again. Tori, I hope you're having a great trip because I'm sure you're going to listen in. So welcome back, Rob, to Golden Rule Radio.
Thanks, Miles. Good to be here.
So we're going to start out pretty quick here. There's a lot of news out there that I think we'll sprinkle in here as we're going through stuff. But hot on the heels of the first real correction we've seen in certainly gold in months, ever since we started coming up back at the beginning of November, up well over $300 in the last couple of months. And the expected turnaround on the heels of the Fed announcement in the beginning of February, rising interest rates. Everybody was kind of planning, buy the rumor, sell the news, and we're seeing gold sell the news.
We're within striking distance of what I think would be a great entry point. We're about mid-1870s right now. I'm looking at around the 1830s. Where's the 382 Fibonacci number?
Actually, right there.
It's right there? Okay.
Yeah, so you're not too far off, maybe by about 12 cents or so. But yeah, your 382 Fib's right there at about 1830, and that would be a really healthy place to see a shallow reversal back down. And I agree with you. I think that would be a great place to start stepping into adding to your gold position.
Right. Where's the next point on the chart? What about the 50% retracement?
Yeah, and I think that might even be a slightly bigger question. I'll definitely be buying at, say, a 382 drop.
Right.
But what I'm really looking at right now is that 50% line in gold. And we mentioned this a little bit last week, Tori and I talked about it, but your 50% line is going to be right there at about 1790.
Okay.
So about another $40 down. But what I like most about this is 1790 comparing to, say, your medium-term moving average, the 200-day average rolling price of gold, which is a little bit below that right now. So with gold being quite a bit above that, that's going to pull that average up over the next few weeks. And there's a good chance you may see a couple indicators line up here right at that 50% line, where you have your 200-day average right around 1789, 1790. You've got your 50% line at around 1790. And if you look back to the activity in December, that's where we had a little bit of resistance as December was breaking through this level you can see on the chart. And that's actually the last high we put in back in August on the way down.
Okay.
So there's a number of not just the price action, the action of the price going up and down over the last 6 months that has bounced around that 1790 number. You also have some charting indicators that are going to line up there as well. So I would argue when we get, if we get past the 382 Fib,
right,
because we may just turn at the 382 Fib and just start going up again, and that would be extremely bullish for gold.
Well, and we are looking at the strongest period for gold the last few years has been the spring market.
Yeah,
March. Not the fall market, the spring market.
Right.
So if people are looking for an entry point, they need to get serious because we've only got a few weeks left in February before what I anticipate to be a very busy March, April market for gold. And I was very concerned that we could have a drop in the stock market followed by a drop in the gold price like what we see.
Right.
Lasting for a few days or a few weeks, then gold recovers. But with the way that Powell came out trying to do his best Alan Greenspan imitation and say two things at once, the market took it as he was blinking. The Fed is not going to be aggressively raising interest rates. They took the bit in their teeth and they raced ahead.
It's the only thing the crowd knows how to listen to. It's just they only have one tool in their toolbox.
Buy.
And everything's a nail. All they own is a hammer.
Yep.
And I'm also getting kind of sick of hearing the questions after he gives his speech of just asking when we're getting the punch bowl back.
But having said that, I don't anticipate that happening this spring.
Mm-hmm.
Maybe later on this year we'll see a sell-off in equities, but it looks like equities are going to remain stable. And if he continues down this dovish road, going to get bullish for stocks, and gold isn't going to be left behind.
No, not at all. You know who else would love to get that punch bowl back is Janet Yellen. I'm sure would love the punch bowl back too, because the debt ceiling is getting very expensive for the U.S. government.
Right.
And that's something we'll definitely be watching here as they've kind of extended that deadline a little bit here this spring. But it looks like they might even be starting to cut off some funding, at least short-term cut off some funding of some various government programs and pensions and TSPs and the like we've seen in the past. Although it's not the Parks District like it was a few years ago. We're getting into some potential messing with federal employee retirement accounts that I want to do a little more research on.
Okay.
So speaking of not cutting the punch bowl off and markets like gold and now silver trading kind of the way they should be, it's pretty healthy, natural trading to be doing what gold's been doing, taking this decline back down. Silver is actually leading by a little bit, which is unsurprising. You know, silver does tend to be a slightly more volatile metal, and it tends to do things a little bit ahead of gold, has been my experience. You know, silver topped out a little bit before gold did, just shy of 25. And then when you look at where we started back in September, you know, gold started rising in November, silver started rising in September. So where silver started and ended, we're actually at the 382 fib. As of yesterday, hit it almost to the penny yesterday, and a little bit of a bounce today. Also, just like gold, you've got your 200-day moving average, which is right down there about the 50% line. So we could see kind of a recurring theme in the precious metals here over the next few weeks, where we get a little bit more down pressure into some really good-looking chart levels.
But our clients shouldn't be waiting for it to go any further down. I think we're getting to a point where this is going to be one of their last best entry points for this year.
Yeah, and I agree. I think this is kind of tapering your entry points into gold whenever you see these kind of pullbacks. Because me personally, I just want to stack ounces. And if I get the opportunity to stack 1 ounce a little bit cheaper than the last one, that's fine with me. In the long run, you know, I've been buying gold 20 years. I know you've got me doubled on that. I couldn't tell you a single price I've ever paid for a single ounce of gold I've ever bought. So I know it's fun to sit and talk about these charts on a regular basis. It's not a gambling thing. It really isn't.
No.
It's just if you can shake a few more quarters out of the couch when it makes sense to do so, and it's outside of maybe your regular investment timing and strategy, this is what we're trying to do here.
Yeah, and I think we've got maybe 2 to 3 weeks to take advantage before it starts to reverse back to the upside and the next leg up begins. And I think that next leg is going to be, historically has been, and I believe will be this time also, very explosive.
So rounding out the metals, gold almost at the 382. Silver just hit it. So where do you think platinum is? Just below it. So the more volatile you get, the more reversal you get. So same thing, platinum started its rise back in September, ended about the same time that silver did right at the beginning of the year, so a couple weeks ahead of gold. And yeah, platinum's on its way down to the 50% line, just $20 away, even less than that.
Yeah, it doesn't even hardly matter at this point.
Right. So because we're still probably going to see a little bit more downwards pressure in gold, I'd actually like to see platinum go a little lower. So I put this chart up a couple weeks ago. I'm glad it's playing out the way I hoped, but I'm still shooting for like 925 as a bottom on platinum. So I'm probably going to be looking at just starting to chip into platinum here as well over the next couple weeks. I'm not waiting for 925. But if we end up hitting it, maybe that'll be it'll be like the second ounce I buy, not the first. So all this kind of hinges on where the U.S. dollar is going. The dollar's had a nice bounce that didn't seem to last very long, which makes me a little nervous here. I was hoping to see a little bit more upwards pressure on the dollar.
No, I don't think we're going to. We've lost too much prestige.
You know, and we pointed this out a couple weeks ago as well. When you see some of these longer-term moving averages cross in something like a dollar index, which is a very slow-moving animal, when you think about the largest market on the planet, which is the U.S. dollar.
Absolutely.
We had one of these big moving average crosses a couple weeks ago, so the likelihood you're going to see the dollar continue up in strength is minimal. Not impossible, but minimal. And it's nerve-wracking for me when we're in a rising interest rate environment and the value of the U.S. dollar is declining alongside of it in the international market.
Mm-hmm.
I'm not too hopeful for the purchasing power of the U.S. dollar unless, as we mentioned a minute ago, Janet Yellen in Washington and Jerome Powell, and something has to give. One of Tori and my big arguments for the last couple of months is raising the interest rates is necessary, but there's a couple more things you got to do. You got to curtail government overspending. So you got to mess with the debt ceiling on the government side, and then you have to mess with the investment book on the Federal Reserve side as well. You can't just raise, thank you. You can't just raise the interest rates. You have to start working on the balance sheet as well. Otherwise, all you're doing is you and the federal government are just borrowing at higher rates.
Right. And that's going to take up an increasingly higher percentage of revenue to Uncle Sam. And that's where it starts squeezing the budget.
Right. And it squeezes the American taxpayer budget as well. And you're seeing that in the Dow.
Yep.
Because the Dow has had a nice bounce.
Now it's struggling.
But we haven't put in a higher high off that bounce since back in, beginning of December? So we're starting to trail off again in the equities market. We've had a couple bounces in, say, some of the high flyer tech stocks. I know that Facebook Meta, I'm never going to be able to call it Meta. It's always going to be Facebook. But Facebook Meta had that great bounce here recently, but it was also off like 85% in a year.
Right, and it's down about 6.5% today. I mean, that's a big loss in one day.
Right.
Now it's down 7. Well, no, my bad. It's recovering. It was down 6.5. Now it's reversed. It's only down 3.5 now.
Yeah, news headlines say Facebook Meta up 3% in the last 2 hours. So there you go.
But poor Google, it's down 8% today.
Right. So the wind in the sails blew out pretty quickly.
Yeah.
So with expectations of continued declining equities market, with no end in sight to government spending, they can continue to finagle with the accounting books as much as they want to, but you're just shuffling things around at this point. We're going to keep bumping the debt limit every year.
Yeah, and I think we've seen the big move for equities. My guess is we're going to trend sideways in equities for an extended period of time until reality starts to set in, and we'll see what happens then.
Because they're generally accepted accounting principles for you and me, and they're government accepted accounting principles for the government, and those are two very different rule sets.
Yeah. Well, that's all I have for today, Miles. What else do you have?
I think just our closer, Rob, so thanks for coming again. I appreciate it. I'm going to make a bet that I'm going to drag you in here for the next couple weeks.
Okay, sounds like a good
deal. So we'll see if that works out. Right. So if you want to hear more Rob, make sure to catch us again next week. And thank you again for joining us this week for Golden Rule Radio. If you liked what you heard, do the YouTube things. You know where the buttons are now. YouTube's been out long enough. In the meantime, why not head over to our website? You can find more info at McElvaney.com. We're on Twitter at ICA Gold and Facebook at McElvaney Financial. Better yet, if you'd like to chat with Rob, myself, or any of the advisors here at McElvaney Precious Metals, you can reach us at 800-525-9556. Thanks for listening and have a great week.